your screens. So lots to track, and the market indicating a 75-point higher start, at least in the pre-open session. That's about 1/3% at this point in time. What do we have? We'll do indices and we'll get into stocks. First rates anytime now on the big indices. Yeah, it's higher. The question is whether we will hold on to some of these levels. So 23,080 is where we are at, about 1/4% higher. And the Nifty Bank is starting about 0.15 up, 48,666. The Sensex is starting about 260 points in the green. The IT index is up about 0.6%. 780 stocks are higher and about 430 stocks are lower. So that is the advances to decline ratio. We've got 39 odd names in the green and about 11 stocks which are starting in the red at this point. So that's the Nifty heat map. It's a positive start, and I think I should emphasize it's the start. So we'll see where we go. Survi.
Absolutely, and the positive start is more or less taking everybody along. But look at the mid-cap index. I already see a flash of red on the mid-cap screen so early on. Anyway, sticking to the large caps for now. Sun Pharma 1.5% higher, Shriram Finance 1.5% higher, Reddy's is up about 1%. There's a bit of tech in the mix. You've got Infosys, Wipro, TCS, all these stocks are up and about. Tech Mahindra is up about 0.5%. So tech is looking okay. Bank Nifty is absolutely flat. HDFC Bank 0.3% or so. Let's see what the other big banks are doing. ICICI Bank is totally flat. SBI is actually slightly lower, about 0.5% lower. So Bank Nifty not in the mood today. What else is leading the up move? There's some consumer and auto. So Maruti, Bajaj Auto, these are names on the upside. There's HUL, Tata Consumer, ITC. These are the names on the upside. But the gain has already now reduced to about 60 points. Let's see. Holding onto these gains is going to be critical. On the downside, there are a couple of PSU names like BEL, BPCL is weak. There's Tata Steel, which is on the weaker side as well. ONGC. The commentary that we've got from Mr. Jindal, the next 15 days, there could be some news on safeguard duties. It's not firing up the stocks just as yet. Still lower for most of the steel majors. Nigel.
Well, you got the accident of the morning. That's IndiaMART. Stock is down close to 10% as we speak. So big downtick is what we're seeing. Zomato and Swiggy continue to see selling pressure. So the stocks of the one-day year, so to call it, they in fact are lower. Zomato, Swiggy, IndiaMART, they all had a big re-rating in terms of their multiples, valuations as well, and now they're pulling back a little bit. Stocks that are doing well, Jana SFB, that one's up close to 7%. That's the star of the morning, flying away as we speak. So big up move is what we're seeing on that particular name. I think Newland Laboratories as well, they're talking about a new capex, so I think the street likes that. So that's another big mover this morning. And also the point that we made earlier on Dalmia Bharat, that the numbers were weak. However, valuation support and the other factors, management is sounding optimistic about the journey from here on. So that's why after having numbers like that and you have more than a 10% miss on the EBITDA estimates, the stock is down only around 1% or thereabouts. ICICI Prudential, that's the other one that's taking it on the chin, down 6.5%. And Kalyan Jewellers, the one we spotted yesterday as well. Increased pledge from the promoter. The street is a little bit nervous. Promoters' hands are tied till the results come out. So we'll have to see what happens post then. For the time being, the stock under immense pressure.
You mentioned, Nigel, accident of the morning. I don't know if you mentioned Cyient or not, because there's a competition between accident of the morning between IndiaMART and look at Cyient DLM. It's 11% lower. Margins are down almost 300 basis points. The profit fell about 40%. Look at the drubbing the stock is getting now.
Actually, there are lots of these names, right? I mean, another, I don't want to call it tax, maybe it is an accident. ICICI Pru, 7% cut. Yeah. That's a large name coming through. Stocks under 600 rupees. So it's not a good look for broader markets. I mean, already you got some 2.5, 3:1 in terms of declines to advances, straight out of the gate, and lots of volumes on the downside. I mean, I think I had to mention that as well. So ICICI Pru is down 6.5%, of course, results reaction. Look at Vari Energy is down 5%, so coming up with large volumes. Persistent is down another 3.5 odd percent. Again, these are all top traded names. Kalyan is down another almost 4%, 470 now on Kalyan. So there was that one blip on Monday. When the stock ended higher, it reversed yesterday and continues to head south. Dixon was the big casualty yesterday. It's down another 3% this morning. So, just under the 15,000 rupee mark now. 14,740 is where Dixon is at. It's got 100,000 shares. IndiaMART we mentioned, and I think Zomato we mentioned as well. Zomato is now a green candle, but the low has been made at about just under 204 for the day. It's jumped about 6 rupees from the lows, but we'll see what it's able to do. Swiggy is down at about 430, 2% lower. Yesterday, another area which got smacked around is all real estate names. Lodha was down sharply. Oberoi was down sharply. So Oberoi is starting another 5.5% lower. That is Oberoi Realty. We should look at Lodha as well. A bunch of other names there which are starting. Policy Bazaar down about 3%. Again, large volumes down at about 1,600 rupees. Newgen ended 15% lower after results yesterday. It's down another 7%. I mean, so, it's if you want to look at what's down on volumes, it's really rich pickings right now in terms of what's going on out there. On the upside, I mean, I think we mentioned Jana, which is up, but that's about it. Reddington was up yesterday. It's up another 4%. Otherwise, it's all small. 1.5%, 2%. I can spot a Shakti Pumps, which is up about 3.5%. But that's it. Otherwise, it's all very small at this point in time. So
but let's be optimistic. The large cap screen is still holding on. When we started, there was this big fear because we were dipping from 70 to just a 40, 30 point gain. But now at least large caps, 90 points up.
Absolutely. And as well as, hopefully, just a hope that maybe a market starts to stabilize a little bit around the lows that we made, which was just slightly below last week's low. Taher Badshah is Chief Investment Officer at Invesco Mutual Fund, and he's going to tell us if the market will do that or not. Taher, good morning. Great to have you with us here. Appreciate your time. Prashant this side. So, if you look at the NSE 500, right? I mean, the primary concern has been valuations. I think till about a week ago, the median price to earnings ratio for NSE 500 stocks was about 45. Many stocks high P stocks have corrected especially, but the problem is they were very high, now they are just maybe high. So where does it leave us, Taher? And it's kind of a tough one because it's essentially been almost, it's not new, right? These high valuations. We've had high valuations for a decade now, relative to history in that sense. So what's the new normal in that sense and where should we settle? Your thoughts, Taher?
Well, I think some of these obviously were somewhat a lot more extended compared to what even their own strong fundamentals would probably justify. And I think that part of the correction is essentially set in, and we've seen the impact of that over the last some time. I think it's also a consequence of the developments in the last some time, basically with regard to the narrative. Overall narrative has actually come as a significant negative surprise and affected the valuations of many of these companies. I think at one level, my sense is that we have somewhat turned significantly, risk averse from an economic standpoint. In various ways, we've deleveraged to a substantial degree, whether you look at it in the form of either a fiscal deficit or probably you look at it in the form of interest rates, liquidity, even regulation for that matter. I think in various ways, we are at that extreme, and I think we need to loosen up a little bit because in doing all this, I think we're losing the plot as far as growth is concerned. And that is what is essentially creating this impact because the confidence in growth is somehow, lessened in the course of the last 2 odd quarters. So I think that is something which needs to, the overall, market backdrop essentially needs to be rectified in order for some of these valuations to hold up. But I think some of these franchises which have seen this decline, they are also at the same time pretty dominant in their own way. They have executed very well in the last some time. And therefore, in few of these which we also own, we are keeping our faith. We know that they are in a position to grow at least ahead of system rate of growth, well ahead of system rate of growth, if not in those very strong growth rates that they probably witnessed in the last 3-4 years. So I think some of these franchises at lower valuations or at more reasonable valuations compared to earlier would definitely start looking interesting.
Taher, hi. So I know you won't name stocks, but which are those pockets where you're not letting the price destruction sort of, change your stance or your thesis? I mean, I just want to throw in names of what we've seen in the last, I think, 24 hours. One is this entire quick commerce space, right? Where there's a raging debate on whether in the short term, at least, there's a complete lid on profitability and margins. The other space yesterday was EMS. I mean, look what happened. Dixon came out with pretty decent looking numbers, and we know their business, we know their margin profile, but the stock sold off as if there's some major calamity happening. So just, talk us through these two pockets at least.
So, both these pockets still look interesting to us. We believe that these are the pockets, like as I said, which will still demonstrate growth, which is well ahead of system rate of growth. But obviously, there was an excessiveness as far as valuations concerned. We were aware of that, and we've still continued to hold some of these names simply because of the fact that the pathway to growth and the visibility as far as longer term growth is concerned is still much higher in some of these names and some of these parts of the market. So. I think yesterday for some of these names, or maybe over the last some time for some of these names to actually have declined, like as I said, is more a function of the backdrop. If the same set of numbers were probably reported by some of these companies 6 months back when the overall backdrop was relatively better, I don't think the impact would have been as high. But I think we've got challenged in terms of the outlook as far as overall growth is concerned. I think we are obviously affected by some of the developments from a global standpoint. We don't really have a full handle in terms of what the implications of some of these global policies, the way they are likely to turn, is going to either benefit or probably not benefit India. So I think that's where the problem lies. So I think it's nice that some of these names once again are probably likely to get into a relatively more reasonable zone. If these are enterprises which over a longer period of time are going to hold on well to their return on capital employed or return on equity, I think some of those valuations at least will form the lower end of their lifetime valuation bands, I would say. So that we have seen it in many of the other franchises, whether it is in consumer stocks or FMCG names, etc. And I think some of the same, much of the same thing is probably likely to happen in some of these businesses as well. Let's say, digital commerce, or probably you're talking about even capital market related entities. These are do have a lot of long-term structural drivers for themselves, and I think those will definitely support the valuations at a certain level.
Hi, Taher. Good morning. One space which you liked was the power sector, and various ways of playing in transformers, other companies as well. Some of them have come off considerably. Do you continue to hold that positive view? Stocks like Siemens also. Siemens has corrected, I think, more than 25% from its peak. Maybe valuations went out of whack. But there are very other pockets that have a longer runway. However, valuations seem to have got a little bit frothy. Your take?
So we are maintaining our confidence, Nigel, in many of these names as well, in these parts of the market too. But we also have to understand that some of these things are hostage to government policies and government spends, public expenditure, and so on and so forth. And we need that overall narrative to actually continue to provide that essential backdrop. But I think some of these entities have their own journey as well, because they are better configured, they are well positioned from the point of view of relevance in the overall scheme of things, their product lines, etc., the ability to participate in the change. So I think we have to, all these things do require a little more patience. Obviously, we are coming from a situation where many of these stocks have done exceedingly well. So a 10-15% odd correction where valuations probably turn a little more reasonable is not something which is not par for course. I think we just have to kind of wait through.
Okay. So we've discussed, some of the sectors where you still remain optimistic. Taher, the other question in front of the market now is that whether there is any point in going back to the old favorites, PSU stocks, capex plays, whether it's PSU or private sector, or whether that kind of whole trade is over and done, at least for now. We are moving to the budget. It's anyone's guess whether the government really picks up on spending again or not. But how are you positioned on the capex side of the market?
So I think we have, at one level, I would say over the last 6-8 months, somewhat reduced our exposure. I wouldn't say a good lot, but we have moderated some part of it. I've told this earlier as well, that we've tried to diversify to whatever extent possible, keeping in mind that we also need growth. I mean, we can't necessarily get into pockets which do not necessarily provide that minimum growth requirement. I think it is better to target growth which is a little ahead of system rate of growth, even if you have to pay a little higher valuations than compared to looking at something which is probably well below that, and yet not as cheap either. So I think that we maintain, but we have tried to ensure diversity to whatever extent possible. So that's how we are basically treating it from an approach perspective.
The EMS companies, right, which you said, what should one pay for these companies? Yeah, how much on a PE basis you think? So 25 for some of these companies was very, very strong, 25 over 24. but growth rates will now settle down a little bit, right? I mean, still very high, 30-40% in some cases. I mean, on a PE basis, what are you willing to pay, Taher?
So Prashant, if you look at it, some of these EMS kind of companies have not necessarily slipped yet on their growth deliverable. I don't think we have the moderation that we've seen in their valuations is a function of the fact that the results have not turned out to be in line with expectations. Perhaps they are in fact on an aggregate basis, better than expectations as well. And I think at some level, a few of these are also trying to increase their TAM. For which probably, the market is a little nervous in the short run, given the fact that, it will lead to perhaps fundraise, it'll lead to perhaps a little more leverage on the balance sheets, if at all, and, may depress return ratios in the short term interim. So I think that is, once again, as investors, if these are companies, like as I said, which can grow well ahead of system rate of growth, and I'm talking about even on a moderated basis, they might perhaps be able to grow at twice the rate of the system. So I think at the minimum. So I think if that is the case, then they will merit significantly higher valuations. Hard to put a number because there are good number of other factors which also play a role from an environment standpoint. So, but I would like to think that these will command valuations which will be much stronger than what the rest of the market would probably do.
Okay, all right. Thanks a lot, Taher, for joining in and giving us a view on the markets. Looking forward to chatting up with you in the coming weeks. By the way, the markets, the headline index is holding with a gain of 70-80 points out. The problem is in the breadth of the market. A lot of selling pressure is what we're seeing. And just one stock that's doing well, Jana Small Finance Bank, just take a look at that. That's the green part of the market. Very, very good set of numbers. Street appreciating that. Let's focus on another set. KEI Industries reported a mixed set of numbers. Cables and wires, they led the growth. Solid one out there, but margins contracted a little bit. What's the way ahead? We're joined by Mr. Anil Gupta, the Chairman and Managing Director of the company. Hi, Mr. Gupta. Good morning. Let's address both these two aspects. First, your cables and wires business. If I take a look at your revenue growth, though the composition is very different from Havells, well, you seem to have done relatively better. So the first part is, have you gained market share, and what is the volume growth you'll be looking at in this segment? Point number one. And the second point is on the margins. Raw material costs have been fluctuating, and that's what's put pressure. Do you believe in Q4 onwards you get to that 11% odd margin that we were talking about earlier?
Thank you very much for inviting me to your show. Good morning. We have grown, in our wire and cable business by around 18 to 19% in turnover. Actually, it is 20%, but in volume around 17% we have grown. And so far as margin is concerned, lot of fluctuations in the dollar and LME, both aluminium and copper, which led to little bit of contraction in the margin by 0.5%. But I'm sure that it will normalize in the full year. In the next quarter, when we see the 12-month results, it will be near to the target what we had projected in the beginning of this year. And in the volumes also, we will try to maintain our growth sequentially in the same manner.
All right, Mr. Gupta, a couple of questions then on this aspect. The way you calculate and, some on the street calculate is a little different. So I just wanted to confirm Q4 margin improvement will be to the tune of around 50 basis points to 100 basis points in comparison to Q3. Should that be the understanding?
I expect the improvement by 0.5% in the Q4.
50 basis points. We'll hold you at that. What about on the market share front, sir? As you have said, you have grown at around 17%. What is driving this volume growth? It's the positive part of a number, so I ask you this. And have you gained market share? It appears so.
I don't know whether we have gained market share, but we have grown by focusing on current favorite projects like solar, like infrastructure, power transmission and distribution, and as well as exports. Truly speaking, in our wires and cables, we have increased our export by around 20%. The number looks little different because our EPC export sales, which was more than 150 crore last year due to our Gambia project, is almost zero this year because that project is nearing completion. So, but wire and cable business has grown substantially.
Mr. Gupta, hi, good morning, sir. So let's talk about volume projections for both for FY25 and also going forward, because you're undertaking major capex in Sanand, and I think you've also taken some more land in Gujarat. So take us through the expectations for FY25. What will be the total volume growth in your wire and cables business? And as some of these expansions come on stream, what should we expect in FY26?
We have maintained a guidance of around 16 to 17% in the volumes, and consequently, the value increase will be related to the prices of raw materials. And we expect to maintain the same volume growth in the next financial year, what we are maintaining this year, because our Sanand project production of first phase which should be coming by end of June. So the results will be visible only from second quarter. That too for the around 35 to 40% of the project.
But sir, you're saying 17% volume growth for FY25. Now with Sanand coming on stream, the first phase, again you're saying FY26 volume growth will also be around 17%. Should it not be higher because you're putting more capacity to work?
It may be higher, but I don't want to comment, too bullish at this moment, because projects always ramp up gradually. You can't expect that on the first day of production, we will achieve 90% of its capacity.
No, I was saying year as a whole, sir. FY26, the ramp up will happen over the entire course of the next financial year. So that's why I was asking, not for Q1 or something like that. Generally, FY26, what should volume growth be? Because overall capex will be coming on stream.
We expect a sales of 1,000 to 1,500 crore from Sanand next financial year in the remaining period of 9 months, because the production ramp up takes time. We need to take factory specific approvals from the customers, audits, etc. So that's why we are a little slow on giving the guidance from Sanand on a big volume. But FY27 will be very strong.
FY27 will be very strong. Mr. Gupta, good morning. Prashant here, and good to see you, sir. Now, in a couple of weeks, we'll have the union budget. There have been two problems last couple of years. Last year, maybe because of elections or whatever. Spending has been low in terms of what has been allocated. And allocation itself came off quite sharply. If you look at I'm talking about towards infrastructure sectors. After many years, a very strong allocation. How critical is state spending? Generally, it looks pretty robust out there. If you look at power transmission bids and other segments that you're involved in. But how critical is the government pushing the pedal in terms of allocations when the budget is presented this time?
I think the infrastructure spending is always very critical for our industry, because most of our product goes into the infra project, energy sector, and in renewable, where a lot of growth is coming up. But I think transmission lines, evacuation of power through the transmission lines is important, which is normally coming up now through the tariff-based competitive bidding. So we expect that this national transmission plan, electricity plan, which will bring some good investments in transmission sector also next year. And in whole energy segment, power generation, transmission, distribution, and the power consumption sectors like industry, infrastructure, and real estate, they will bring bullish trend in the wire and cable demand.
Okay. All right. Very quickly, sir, before we let you go, the EHV part of your business over there, because of slow clearances, I think that's what was the big drag, and that's why there was a sharp degrowth in the past quarter. Have things stabilized?
Yeah, it is improving, and we expect a good numbers in this quarter. But we have utilized that capacity for our HT cable production, and you can see that in HT cable segment we have grown by 49%.
Got it.
All right, we'll leave it there, Mr. Gupta. We'll look forward to our next chat. Thank you very much for joining us and running us through some of that sort of commentary. So just under 4,000 rupees is where KEI is now trading at. It's been one of the huge big wealth creators, 10x in the last 5 years. for KEI. We'll take a break. We are back and we'll have the management of PNB Housing Finance joining in to talk about third quarter earnings and the outlook. Stay tuned.
Welcome back. As we speak, a few stocks are coming off their lows, so we're trying to look at some positives. IndiaMART, case in point, the stock has come off close to around 5% from the low point of the day. But let's talk about another one that's getting a drubbing in early morning trade. ICICI Prudential, that's trading weak. Vamakshi joins us to analyze those numbers for us. Vamakshi.
Well, Nigel, when we look at the new business premium, that saw an uptick of 53.5% coming in at 6,441 crores. The total APE was also up nearly 27.8% at 2,438 crores. This is more or less in line with what the street was estimating. But the big hit is coming as far as the VNB margins is concerned, because that has come in much below what the street was anticipating. Now, keep in mind the VNB margins have contracted from 22.9% to 21.2%. And resultantly, there's a miss on the VNB front as well. VNB is up 18.6% at 517 crores. Now, there are a couple of brokerage notes that have come out with their take on the numbers. HSBC has a buy call. Target price has been cut from 825 to 780 rupees per share. Morgan Stanley is the next one. They have an equal weight call. Target price of 695. They too allude to the fact that VNB margin misses the company, the brokerage's estimates. They've gone ahead and trimmed their VNB forecast by 2% for FY25 and 27, considering the miss on margins. Macquarie has a neutral call, target price of 725. They say that Q3 FY25 VNB growth has disappointed yet again. A higher ULIP, declining savings and higher costs have affected margins, and they see further downside to FY25 VNB estimates. So overall, doesn't look like a good picture for ICICI Pru.
It does not. And look at that stock sliding 8.5%. Thanks, Vamakshi, for reminding us once again about the reasons and the issues with those numbers. Q3 disappointment playing out on ICICI Prudential. The next company on our radar is PNB Housing, also on the back of results. And the stock has cooled off actually from the morning highs. It opened positive, but since then it's down about 4% from the peak. And overall, if you look at PNB Housing in line with the market correction, the stock is about 25% off the 52-week high itself. So what are the trends in the third quarter and what's the outlook? Well, let's take this up with Mr. Girish Kausgi, Managing Director and CEO at PNB Housing. Mr. Kausgi, always a pleasure having you on. So, I mean, year on year, the growth number looks okay, but sequentially, of course, one can argue that over Q2, Q3 disbursements are lower. But I want to start with the brighter spark in the numbers, and that's margins. Because you've actually managed to improve margins by a shade quarter on quarter, even year on year, the margins are looking better. So what went into that? How is your cost of borrowing moving? And what can you guide for, considering the market is expecting rate cuts this year from the Reserve Bank?
Well, good morning, Surabhi. I think if you look at quarter three, it was pretty good. If you look at the demand, mortgage industry is doing well. Demand is quite robust. But I think this year, quarter one, quarter two, quarter three, there has been some challenge for the industry because of various reasons, and quarter three the challenge was much more. But if you see PNB Housing, quarter one, quarter two, quarter three, all the 3 quarters we have done pretty well. Well, if you compare with quarter two, I think disbursement is slightly up. The book has grown by 4% on retail, so I think quarter three is pretty good. There's an income growth of 11%, net interest income growth of 17%. PAT growth of 43%. If you look at NIM, it is quite stable. If you look at ROA, it is 2.51. I think on all the metrics, we have done pretty well. Talking about margin, our guidance is 3.5%. So we will be able to maintain around the current levels, let's say about 3.6 to 3.65 in that range. Our cost of borrowing now is 7.83, a notch lower than what it was in the previous quarter, 1 bp lower. So we've been able to manage a cost and slightly increase the yield. Yield now is 10.12. So I think overall it's a pretty good quarter, because you will see some of the companies in this quarter showing YOY decline in disbursement. That's because of certain challenges, nothing to do with the demand.
So you're saying that even if we get into a rate cut cycle, you will maintain margins at around 3.6, 3.7%, right?
Yeah, that's right. I think we are expecting a rate cut of about 25 bips. That will have an impact of 10 bips on the cost of borrowing. We'll be able to pass on that. I will be able to maintain margin around, see, guidance is 3.5. We'll be definitely much above that. And also, if you look at the growth guidance for this year on retail was 17%. We are at 17.5%. So we have already kind of, ahead in terms of our achievement, both in terms of book and disbursement. So I think
so just coming on disbursements in a second to complete that margin, answer. What you're saying is 3.6%, but for FY25, to be fair, I mean, it will be better if you give us some sense of what happens as we get into FY26, because the rate cuts, might continue for the rest of the year. So will you be able to hold margins at 3.6%, even say in the first half of the new fiscal?
See, about next 2 to 3 quarters, we'll be able to maintain around that level. And after that, the margin will slightly start improving for 3 reasons. One, we are changing segments. We are growing our prime book slower compared to emerging and affordable. Affordable now the book is 3,838 crores. We have actually doubled affordable book in last 9 months. So we are increasing affordable, we are increasing the growth in emerging, and lowering the pace of growth in prime. So this is one. We are moving segments, and also we are increasing yield in all the 3 segments, whether it is prime, emerging or affordable, number 1. Number 2, we'll be starting corporate, so that will add to the margins, and therefore because of these reasons we'll be able to hold.
Okay, hi Mr. Koski, and good morning, good to see you, Ben. The affordable book, in the past I think you've said you're looking to grow to around 5,000 crores odd. Any geographic targets you have out there?
No, we are actually present in 13 states. We will expand to 15. So for us, the contribution geographically, I think it is almost similar between South, North and West. South is slightly higher. I think that is more by design. And we have disbursed about 930 crores in Q3, and we should disburse a little over 1,200 crores in Q4. That will take us to a target of close to 5,000 crore book in affordable by March.
Okay. You mentioned corporate, sir, a new segment, and you said that will, of course, aid margins. Can you elaborate on that? Affordable, you've given us some targets, but what are you thinking with respect to the corporate segment?
I think corporate this year will be able to start. So I think coming year we should be looking at about 1,500 odd crores disbursement. So we don't have a big target on corporate. It will be very small in our overall portfolio. It will be always less than 10% at any given point in time.
And when you say corporate, this would be lending to exactly, what sort of entities?
So this will be lending to developers for largely construction purpose.
Okay, so there could be an element of construction financing coming in as well. So that brings us back to now the overall picture on AUM on year. It's up 12% in the third quarter. FY25, what should be the AUM growth? And then FY26, I know it's a little early to ask this question, but since you're going to start this new segment and affordable is growing, what can shareholders look out for?
I think if you look at last almost 3 odd years, we are not selling any portfolio or the pool. And therefore, I think more relevant for a discussion will be on the book growth, especially on retail. So retail this year, our guidance was 17%. We are already at 17.5. So we'll be able to surpass our guidance of 17% this year. And for next couple of years, we have detailed our growth between 17 to 18% on book, which will take us to 1 lakh crore of retail book by FY27. So that is what we have already laid out. So we'll be able to continue with the trend.
That's on the retail side. And total AUM?
So as I mentioned to you, we are not actively selling any pool now. So today AUM is about close to 5,500. So that will run off over a period of time. The focus for us mainly is to grow our book. We want to grow our balance sheet, and in that context, we'll be more particular with respect to retail and corporate growth.
All right, Mr. Kowalski, very quickly, Quality Investment Holdings, that's the Carlyle Group. They have 30% stake, which has come down to around 10%. Any communication from them with regard to what they plan on doing with this 10%?
No, actually, we never engage on these things because Carlyle is an investor and they're on the board, and it is left to their decision. We generally don't get into investment decisions.
All right, because from a shareholder perspective, the street will be waiting by for this to get cleared out, and that could be one of the triggers for the re-rating. So we'll keep an eye out on that front. Appreciate you joining in, Mr. Kowalski. Thanks a lot for joining in and detailing the past quarter's numbers and the vision that you have going ahead as well. Well, it's time for our special segment, Quarter Se Quarter Tak, and where we bring you earnings expectations from every sector. Vinny joins us today to tell us about what she's expecting from the pharma sector. Vinny, over to you.
Good morning. So today, in terms of pharma sector and what we're expecting in Q3 FY25, the pace of profitability growth for pharma companies in Q3 is expected to be slower than the previous quarters. And this is the previous 2 quarters that we're talking about. Now, for Q3 FY25, analysts are expecting pharma companies to see sales growth of around 10 to 12%, EBITDA growth of around 13 to 15%, while profits are expected to see a growth of around 11 to 13% during this quarter, driven mainly by operational efficiencies, INR depreciation, I beg your pardon, as well as a reduction in freight costs. Now, in terms of the moderation and growth that we're seeing and the growth momentum compared to the previous quarters is expected primarily due to the pricing pressure and a high base effect that is coming in. Sales for pharma companies this quarter is expected to be supported by growth that one will see in domestic business, as well as US markets is also something that will support the growth. But India sales are likely to be the key driver during this quarter. And among the large players, Dr. Reddy's can see a very good growth of around 10% during this quarter, while in terms of India business that we're talking about, Sun Pharma is also expected to see a 9% growth on a year-on-year basis. Mid-sized companies, whether you're looking at JB Pharma, Torrent and Mindgan Pharma, are expected to outperform with 11 to 13% growth, driven by chronic portfolios, while Cipla and Zydus on the other side are seen reporting a relatively weaker quarter this time. 6 to 8% YOY growth is what we're expecting, mainly impacted by supply issues as well as base effects coming into play for both these companies. Now, coming to closely watching out, and what is watched out is the US markets. The US generics are expected to see flattish growth due to the price erosion and lack of significant launches in the US market. 5% growth is what is projected overall in the US market for all these pharma companies, and that will be mainly because we'll be supporting the growth. What is it? The specialty business as well as scale-ups that will come in on that front. Moderation in terms of price erosion. That is a key factor to watch out for. And key product launches by some of these companies like generic Spiriva as well as generic Myrbetriq is something that is a key focus in the US market. In the US market, what we can also expect is Revlimid sales are now going to start becoming lower. So that will impact Dr. Reddy's, Aurobindo, Sun Pharma, Zydus, as well as Cipla versus sales booked in the previous quarter by these companies. Now, company-wise, when you look at it, Sun Pharma could grow in the range of somewhere around 8 to 10%, mainly led by the US specialty portfolio. Cipla and Zydus could see a decline in terms of growth sequentially in the range of 5 to 7% in the US business, mainly due to supply constraints. Dr. Reddy's growth will be supported by contribution that's coming in from the latest acquisition. This is the first quarter where we'll be combining this acquisition, so keep an eye out on that one. EBITDA expected to grow in the 15% range YOY for the pharma sector. Overall, on overall basis, it's expected to remain flat on a sequential basis. Cipla, Dr. Reddy's are likely to witness margin contraction, while Sun, Lupin, DVs are expected to witness strong margin expansion this time. Commentary will be key from pharma players that will remain in focus. From Biocon, especially, they have got the clearance coming in for 2 of the biologics plants, so keep an eye out on that. Dr. Reddy's in terms of timelines of approval for new product launches, or Aurobindo Pharma in terms of progress of breaking even in penicillin G is something that they'll watch out for, and capacity addition. And also in terms of Cipla, watch out for timelines in terms of recovery for some of their sales and products is going to be a key factor to watch out for. Now, overall, while Q3 is expected to be stable quarter for the pharma sector, the growth momentum has seen a bit of a slowdown, and companies with diverse portfolios, strong execution in the US, robust India's business sales are the companies that will outperform overall in the pharma sector. And before we leave you all with what is expected in pharma sector, let's look at the valuation also, because valuation is very interesting. That what we are watching out for. Most companies are trading above or around the 5-year average, so quite high in terms of valuation, Nigel, and that's what we'll keep an eye out on.
Thanks a lot for that, Vinny. Well, let's discuss this in further detail. We have Sumit Gupta, AVP Research at Centrum Broking, who joins us on the show. Hi, Sumit. Good to see you in after a while. Tell us, what is that company that can give a positive surprise for Q3, according to you?
Hi, thanks for having me. Good morning. Yeah, so like overall pharma space, we expect within our coverage universe, so we expect around 10 to 11% kind of growth led by good performance in Indian pharmaceutical market, as well as subdued performance in the US market. So US market continues to be led by niche launches, easing pricing pressure, and INR depreciation also leading to some bit of growth. However, if you see from company specific point of view, we expect Cipla's US sales to decline modestly by 3 to 4% due to supply side constraints in lenalidomide. However, this phenomenon is expected to be for this quarter. However, we expect from next quarter also it will normalize. However, if we expect Dr. Reddy's sales, so we expect that to grow at around 7 to 8%. So, and Sun Pharma's specialty portfolio continues to drive the overall US portfolio, and we expect around 15 to 16% kind of growth in the US segment for Sun Pharma also. Coming to the domestic market, we expect basically growth will be led by new launches or the in-licensed portfolio and the core brands. So on organic basis, we expect around 10 to 11% kind of growth. Let's say for JV Chemicals, we expect 11% kind of growth. However, with including the off-health portfolio, we expect 22 to 23% kind of growth. So this is the kind of growth that we are expecting for this quarter.
Okay, all right. In terms of commentary, as Vinny said, that's going to be essential. Give us a couple of those data points, company specific. What's the commentary you're looking at? If there's any particular trigger that you're looking forward to.
So let's say for US Cipla, so how the lenalidomide or the specific key launches are there, and what kind of pipeline timeline that we can expect over the next few months or the few quarters. Or let's say for JV Chemicals, how they are planning, how they are expecting, you can say, how they're expecting their particular launches to go forward from here on. So it's very company specific to like very drug specific and from company to company. Sun Pharma specialty portfolio continues to do well. So it will be very company specific.
Sumit, hi, morning. You have coverage on Aurobindo? And if you do, no, you don't. Okay. Come off very sharply. It's basically back to previous lows of about 1150 or so from the recent high, about 10 days back, about 1350. So that is Aurobindo for you. Apart from that, we've had some fund managers we've spoken with talking to us, and this is beyond the third quarter. Maybe we'll hear some of it in commentary, etc. we've had in the past. Indian generic companies, pharma companies talking about the GLP-1 opportunity and how they plan to sort of go after it. Anything you expect to hear from any of the companies under coverage?
Yeah, this will be one of the key focus in the commentary for this quarter across the pharma space. So GLP-1 continues to be a good opportunity for the near to midterm. So we will see continued traction from analyst community too for the asking the pharma space, and overall we will see positive commentary on this.
Kind of commentary, and from which players and who is best placed according to you, Sumit?
So there are multiple players. So it's a multi-billion-dollar opportunity, and we see be it Reddy's, be it Cipla or some other companies. So there are various players which are coming.
Okay, all right. Various players which are coming. Just in terms of, we don't know whether this is really going to play out in what shape, form, etc. Do you expect, at least during campaigning, overhauling healthcare in the US was a big campaign promise, right? We've not heard anything on that front as of yet. Do you think, is that a question you get from investors at all, something to track? Or you think, it's really a non-event in that sense?
Yeah, nothing much from on that side from the investor community as such. Basically, like India, India's pricing is very attractive in the US market. So, I don't see much much impact on the Indian pharmaceutical companies on the negative side. So, I don't see any like negative. On the contrary, it might be positive. So, like if there is anything which might come, and Indian pharmaceutical companies are very much positively placed in terms of pricing and in terms of volume share.
Okay, all right, Sumit, we'll leave it there. Thank you very much for joining us, and we'll speak to you once we start to get some of these numbers out from these pharma companies. Okay, I think the market, by the way, is still holding 80 points higher, 23,100. Mitessh is with us with what he'd want you to do this morning at 10 o'clock. Mitessh, what do you have?
So, Prashant, nothing much on the index. Seems like we'll go back to a choppy range. So, we'll avoid the index for the timing. But on stock side, Wipro is something, which has caught my attention. Buy here with a stop at about 298. Look for a target of 318, 320 to begin with. Maybe eventually higher levels, but that is what I think the stock looks like poised to do. And the other stock on my list is a sell on IGL with a stop at about 396 for a target of around 365.
Okay, I got that. ICICI Pru is the big damage this morning. Large cap stock which is selling off. Any levels here, Mitessh? ICICI Pru?
So ICICI Pru, I think, has had a gap down and then a big follow through on the negative side. I think the stock is heading towards 540, 535 zones. So there's still about 70% kind of a downside left.
Something like a Oberoi Realty, is it coming to some support levels? 1750 now after today's fall.
See, Oberoi had a big fall yesterday, and today I think there's some continuation. There is minor support around the levels of 1650, 55, but that is still about 100 points away from. I won't be venturing into Oberoi Realities.
Okay, all right. That's basically all the way back to September 24 levels. And if it does get to those 1600 kind of levels, but big fall last two sessions. Mitessh, thank you very much for joining us. Good speaking with you. On the other side, Manisha joins in with commodities in focus. And so stay with us.
Welcome back. So the mid-cap correction is continuing 1.5% down on the mid-cap index. Let's look at stocks which are really reeling under pressure today, and IndiaMART is definitely one of them after the numbers came through. So let's go across to Rima to look at the fine print. Rima, so what went wrong?
Well, for starters, the stock today has now hit a fresh 52-week low. It's down 18% in the last 1 year and now more than 30% off from its 52-week high. Well, what went wrong? The quarterly paid subscribers. That's the key metric to track the business health of the company, and that saw a decline of 3,700 on a sequential basis. You know, in the good days, the quarterly paid subscriber, quarterly addition used to be 5,000, 6,000. Then when things started getting tough, the business environment over the last couple of days, that quarterly addition came down to 1.5 to 2,000. But this decline seen in Q3 was unexpected and came in as a bit of a negative surprise. Now, the company has said this is on account of, one, the company is focusing more on adding better quality, higher quality customers, and secondly, the holiday season in Q3. Nomura has downgraded IndiaMART to a reduce. The target price is slashed. Earlier, it was 3,150. It's now down to 1,900. They're valuing the core business at 20 times. So even the valuation multiple has come down. Earlier, it was at 30 times. And now they're valuing IndiaMART at a 50% discount to InfoEdge's business. Motilal Oswal, on the other hand, continues to remain bullish in the stock. They have lowered the target price to 2,600, but they argue the valuations are undemanding. Back to you.
Okay, all right. Thank you very much, Rima, for that. That is the sort of big mover, continues to be the big mover on the screen. Well, shifting focus to commodities, Manisha is here with what she's got top of mind. Manisha, good morning.
Well, morning, and I'm looking at the crude oil prices because since the inauguration for the US president has happened, we've seen crude oil prices only go one way, and that has been on the lower side. Well, we started this year on a positive note because there were some supply concerns, but not anymore. To begin with, Trump has declared national energy emergency, and he's talked about three things, especially one, that the permissions or permits would be eased on. The second is opening up more acreage in sense of onshore and offshore drilling. And third, most importantly, is that there would be a reverse of clean energy policy. So that is what really seems to be putting pressure on the crude prices there. And then there is conversation about more tariffs as well. The US president has now reiterated that there are more tariffs coming in for China, nearly 10% of that. And then there are more tariffs also coming in on Mexico and Canada. This would happen on 1st of Feb. Markets also are looking at higher supply concerns. Well, you look at the US oil production, well, that is at all-time highs. Also, OPEC and allies, which is the other part of it, is looking at a spare capacity of nearly 5.8 million barrels per day. So there's that much crude available or spare capacity in the international markets. So less reason that you could be looking at a strong run-up in case of crude prices. But then there are some supportive factors as well. When you look at the US president, he's talked about probably stop buying in sense of crude from Venezuela. That would perhaps bring in some supply concerns because US does import a huge chunk from Venezuela. The second point is that the winter storm in Gulf is continued to raging on. So that demand also is something that's seen in the markets. And then the US will start to refill strategic reserve at a more stronger pace, would mean more pickup in sense of crude from the markets there. The US sanctions on Russia that we've seen recently already have disrupted the physical oil and the tanker market. So there is some near-term premium that we are seeing in various crude varieties coming in. The markets also are reacting to the Saudi Aramco statement that was in Davos yesterday, suggesting that they're expecting oil markets to be healthy. For 2024, the global oil demand stood at around 104.6 million barrels per day. Saudi Aramco's Nasir anticipates that you could be looking at a higher demand at around 106 million barrels per day for 2025.
Okay, all right, got it. Manisha, thank you very much for that. So that's commodities. Now we'll take a break on that note. Coming back on the other side, our special segment, Budget Countdown, coming up. Lata will be in conversation with Deo Shankar Tripathi of Taher Housing Finance and Mahesh Mishra of India Mortgage Guarantee Corporation on what the budget can do for the housing sector.
Hello and welcome to our budget countdown special. In this edition, we look sector-wise for their demands. We start with housing. The budget approaches housing from two ends, as we know for the last so many decades. One, it provides tax exemption for interest and principal payments towards a home loan. It's a small amount, but it is there. Second, it provides housing for economically weaker sections through the PM Awas Yojana, the PMAY, both urban and rural. Since its inception in 2015, the government has sanctioned over 4.2 crore houses. And in June 2024, last year, 6 months back, this scheme was extended for a further 5 years, 24 to 29, with a target of 2 crore more houses. The total expense for the central government over these 4 years is approximately 4 lakh crore, which works out to around 45,000 crore per year for this subsidized housing. What more can the government do? What's the ask of the industry? I have with me two stalwarts, Dev Shankar Tripathi, the Executive Vice Chairman of Aadhar Housing, and Mahesh Mishra, the CEO and Managing Director of India Mortgage Guarantee Corporation, with me here in the studio. Gentlemen, Mahesh and Mr. Tripathi, thank you very much indeed for joining me. Well, Mahesh, first up on the tax, the one that perhaps our audience is more familiar with. This 1.5 lakh, which we get on interest, and 2 lakh on principal, was, fixed long back.
Right.
Do you think there is a reason to ask for more?
Yeah, so there are two parts to this. One, I think there is a consistent focus on growing housing because of the obvious upsides that housing provides. But can there be more? Yes, because there are certain stark data points staring us in the face. If you look at 2 years back, 52% of all home buyers were first-time home buyers. That number is now down to 48%. Okay. If you look at sub 15 lakhs, 61% used to be first-time home buyers. That's now down to about 57-58%. So the first-time home buyer population is going down. The average borrower age is also remaining flat. So
youngsters are not buying?
Youngsters are not buying, or not buying as much. And housing, as you know, has moved from being a pre-retirement necessity in one generation to being something we like to do in our 30s. Yeah. But that's remained flat. So one, as you pointed out, that this whole 1.5 and 2 lakhs was way back in 2014. And if you just look at the RBI's housing index, if it was 2014, it was 100, it's now 178. Okay. So there has been a 78% increase in prices without a commensurate tax benefit flowing in. So I think that's something which definitely the government should look at. The second part, which may not be tax exemption, is stamp duty. I think stamp duty ranges from 4 to 7%, but there is certainly room for a universal reduction to say 2% for first-time home buyers, or if borrower and co-borrower are both under a particular age. Because I think the combination of tax relief as well as across-the-board stamp duty reduction for first-time home buyers is the need of the hour.
Okay. Well, point taken, but why I am a little less optimistic about any such changes is, one, of course, stamp duty, state government. So I don't know, the central budget can only incentivize or, moral suasion, use moral suasion. Secondly, if you look at the new tax regime, they're discouraging exemptions altogether. Yeah, so will they give more?
So yeah, the probability could be low, but if you look at the PMAY...
Need for the hour.
Exactly, and if you also look at the PMAY 2.0, there is still, 50% of our homes are still bought in the top 5 cities. And the PMAY 2.0 caps your unit price at 35 lakhs. Okay. If you look at EWS in the top 5 cities, the average unit price is 26 lakhs. If you look at LIG, it is 47 lakhs. So there is an asymmetry in what PMAY hopes to achieve and what the real estate prices seem to show today.
Fair point. So anyway, you have to inflation adjust. But I think on the issue of PMAY, we have the expert joining us. So let me get to Mr. Tripathi. Mr. Tripathi, have you all presented something to the NHB? What is the ask of the housing finance companies in terms of PMAY urban first? I'll come to rural in a bit.
You see, Lata, the entire country, if you see, there are two schemes available, PMAY urban, PMAY rural. PMAY rural has got a complete different segment where the government of India and state government provide 1.25 lakhs to the very poorer section of society.
Yes.
But the rural area is not the villages where government is providing PMY rural. In fact, if you see if between two districts or between two big cities, there are large number of small towns are developing. Since the census has not happened from 2011, so there are many towns which were having 1,000, 2,000 population. They have gone now 5,000, 6,000 population. PMY urban addresses the location which are approved location where subsidy is given. The large number of these small towns, they are excluded from the identified location for purpose of subsidy.
So 1 minute, Mr. Tripathi, what you're saying is that something like Rurban has grown a great deal.
I'm trying to say.
And they are not getting subsidy, and they're not getting even the urban subsidy nor the rural subsidy, is your point.
The rural subsidy, they don't get because that is hardly 70,000 rupees. That has make no sense. The cost of construction remains the same for everybody. The whole idea is that even government of India has given direction to state government. They can include as number of urban towns which they feel are going to be a pre-urbanization towns in the future. That is what the government of India has given direction. Some state government has given long list and covered many towns. Many state government has not done. So as you were telling, it is all the state government domain. They should see what are the small towns developing between two districts, headquarters or big cities. They should be covered to reduce the congestion in the bigger cities. That's the whole idea, and that will. And you see today, the large number of people under PMOI are in the housing. They are moving tier 1, tier 2, tier 3, tier 4, tier 5 locations because the commutation has improved. In 1 hour hardly traveling time, they reach the city center for the job work. So I think people will not try to live in the cities, but at the outskirts of city are these small satellite towns.
Okay, so the need to include them, I take your point. And you also agree with what Mr. Mishra is saying, that the EWS housing level has to be increased and the LIG, from the current 35 lakhs, I think, we have to make it 45 or 50.
I will take up this point. Government of India in the PMI 2.0, they have authorized state government to revise definition of EWS depending on the location. Maharashtra has done 6 lakhs for EWS scheme and Uttarakhand has done 5 lakhs. So in metros, I think if the state government can revise definition of EWS from 3 lakh to 4 lakh, 5 lakhs, the eligibility of loan will automatically improve. 25 lakh rupees is the coverage in the PMY subsidy. I do agree with Mr. Mishra that amount they have included 35 lakh rupees the cost of property and 25 lakh rupees loan, which precisely should go a little up, and that will cover large number of people in the big metro. The other thing. So another point, Lata, I will take up here.
Yeah, I wanted to ask you, sir, about this affordable housing in partnership. About 15 lakh homes have been done in that, and I believe you are a lender or you are a developer in that area. Now, under 2.0, do you think you can deliver another, 15, 30 lakh houses? Because the ambition is to do nearly 2 crore homes in 5 years. The previous program was 9 years. Now, the ambition is to do larger number of homes. Do you think the same rules will work?
Yeah, Lata, in affordable housing, supply side from big developer is almost negligible. The supply side has to be augmented from the affordable housing in partnership only, which is actually the major project of the Government of India, PMY 2.0. In affordable housing in partnership in 2016, the Government of India has allowed tax holidays to these developers for 5 years, which is now no more available. So in case of affordable housing in partnership, though government in PMI 2.0 has given a lot of direction to state government to reform and frame a policy of affordable housing, provide minimum 5% mandatory EWS LIG in the bigger projects. Number 2, they have provided a Jones in the development plan where the affordable housing property will be there. They give land to the affordable housing developer at a cheaper rate, but the state government are thinking the central government has got pool of land. central government is thinking the state government a pool of land. I think they have to decide among themselves. It's merely making the schemes will not serve unless initiative has to be taken for providing land at the cheaper rate. Along with the land, another thing is there that affordable housing finance developer AHP, this has to be enhanced in a larger way by participation from state government, central government, developmental bodies, and the private developer. Once supply side increases, things will happen in a very nice.
Okay, yeah, pricing, I don't know. You know, we spoke at the time of the election to the Andhra Chief Minister's team, and they were crying about getting land for their capital, Amaravati. I mean, they're going to rival locations, but even the government is not, state government is not able to buy land cheap. Such is their problem. You wanted to add to anything that can be tweaked in PMAY 2.0?
Now, when we are talking affordable housing, when we are talking affordable housing incentives, whatever has come so far has come to the developer.
Yes.
Now, let's also look at the financiers. The target segment of 15 lakhs and below or 20 lakhs and below, wherever you want to peg it, this is a segment that will largely be addressed by housing finance companies. 70% of our lending is still by banks. Housing finance companies are committed to growing low-ticket housing and what is genuinely affordable housing. Now, when we talk affordable housing, we only talk of potentially higher margins because interest rates that they can charge are slightly high. But I think we don't realize that it's a very difficult business to scale up. The headwinds are significant. One, the cost economics don't make sense always. They're not very favorable. Second, collateral quality is not always pristine. Third, underlying risk is high. So it's not very easy to build significant scale as an affordable housing finance company.
This digitization of land has not worked?
It is a slow burn process. I mean, it will definitely work.
Okay.
But it is a slow burn,
I take your point. It is because the margins are very different. The margins for a bank in home loans are under 3%. True. But for housing finance companies, it is like 7 to 8%.
No, we are perhaps underestimating the cost of credit and the unit economics. But I don't see why the government should not provide tax benefits or tax breaks to affordable housing finance companies as long as 75%, I'm making up a number, it can be 75, it can be 80, as long as 75% plus of the origination is in the sub 15 lakh category. Again, I'm making up the ticket size. It can be a decision. But there has to be greater financial incentive to scale up the affordable housing finance business.
Okay. Running out of time, Mr. Tripathi, anything on the affordable rental scheme that I thought that would take off because they were going to use vacant government land. Do you see any proposal there?
Actually, in most of the state government, there are large number of flats they construct lying vacant. That is, the government has said, first of all, utilize those flats for renting. Okay. In bigger cities like Bombay, Delhi, there may not be a possibility. But here, the private sector has to be invited and they have to be incentivized to construct the rooms or dormitories for providing affordable housing and rental. It's a good beginning, but it will take its time. And I am sure that for those who are coming to cities and new people, they can't go to buy a house immediately. They need to be provided the rental housing. Yeah. This will take off. But again, the question of land comes. But if land is not possible, they has to be given to these private developers to create properties. And they can be incentivized by the tax break or something like that.
Okay.
This is what my view is there. One thing what Mr. Mishra was telling, very valid. I will take a minute later here. One thing is missed out. GST concession of 1% is available up to 45 lakh rupees property only. When the cost of construction has gone up by 25-30%, this has to move for the metro cities from 45 lakh to 60 lakh rupees for the purpose of 1% GST concession. Another thing, what Mishra told, Affordable Housing Fund used to be with the NHB. Providing refinance to us at 5% or 4%, depending on the Reserve Bank of India, what they are giving rate to them. In this segment, the pool is slightly depleting. If this pool can be enhanced, the Affordable Housing Finance Company will get funds at a lower rate.
Better refinancing.
And they will be able to provide at a lower rate to the customer. And in this segment, I tell you, RBI has given a sufficient margin to Affordable Housing Finance Company. We can charge 10-year GSEC plus 3.5%. If I'm getting fund at 5%, I can charge 10.5% to the ultimate customer.
Okay, I take your point, sir. That's a fund of ideas and suggestions that have come from both you and Mr. Mishra. Out of time, but we can tweak the existing schemes to ensure that they work better. But the more important point is, it is a 11.1 lakh crore capex budget that the government has. Of that, barely 40,000 crore is going for housing. If we want housing to have such a big multiplier effect, we have to scale it up manifold. If that has to be the plan, then we require a paradigm shift in the government's thinking. We don't know if that will come in the current budget. But thank you very much for this excellent set of suggestions. We wrap up on Bazaar. Chart Bus is coming up.